What I'm about to walk through is not speculation. It's not opinion. It's arithmetic. And the arithmetic just broke in a way that hasn't happened in over 40 years. The gold-silver ratio, the number that tells you how many ounces of silver it takes to buy 1 ounce of gold, just collapsed from 105 to 50 in 60 days. That's not a correction. That's not mean reversion. That's a structural repricing event, and most people watching it have no idea what it actually signals about the delivery system underneath. Hold that number, 50. We'll come back to it. If you've been in markets long enough, you know that ratios don't move like this unless something underneath has snapped. Gold didn't crash. Gold is at all-time highs. What happened is that silver moved faster, roughly 50% faster, over the same window. That kind of relative acceleration doesn't come from retail enthusiasm. It doesn't come from speculation. It comes from one place only, physical demand pressing against a delivery system that was never designed to handle it. By the end of this, you'll understand exactly what broke, why the official narrative won't explain it, and what the next 60 days look like if this trajectory holds. I'm not here to tell you what to do. I'm here to show you the math. What you do with it is your decision. Let me frame this properly. I spent years watching these markets from inside the system, not as a commentator, but as someone who had to understand the plumbing because the plumbing determined whether positions survived. What I learned is that price is the last thing to move. Before price moves, liquidity moves. Before liquidity moves, delivery stress moves. And before delivery stress moves, ratios move. The gold-silver ratio is not a trading indicator. It's a thermometer for the physical market's ability to clear. When it compresses this fast, it's telling you that silver is being pulled out of the system faster than it can be replaced. That's not bullish. That's not bearish. That's mechanical. Let me give you an analogy. Imagine two pipes feeding into the same reservoir. One pipe delivers gold, the other delivers silver. For decades, the silver pipe has been wider. More supply, more flow, more liquidity. The ratio stayed high because silver was always available. You could get it. The system could deliver it. The price stayed low relative to gold because availability was never in question. Now imagine someone quietly narrowed that silver pipe. Not all at once, gradually, for years. And then, suddenly, demand on the other end spiked. Industrial demand, investment demand, sovereign demand, all at once. The reservoir doesn't refill fast enough. The price adjusts, but more importantly, the ratio adjusts. Because the ratio is measuring the relative scarcity of flow, not the relative scarcity of metal in the ground. That's what just happened. The pipe narrowed, the demand surged, and the ratio collapsed. Here's the number you need to anchor to: 60 days. In a normal market, the gold-silver ratio moves slowly. It drifts. It oscillates. A 10-point move over a year is notable. A 20-point move over 2 years is significant. A 55-point move in 60 days is not a market event. It's a phase transition. Let me walk you through what that means mechanically. At 1:5, the ratio implied that silver was abundant relative to gold. The market was saying, silver is easy to get, gold is harder. That's the signal a high ratio sends. At 50, the ratio is saying the opposite. Silver is now scarce relative to gold. The availability gap is closed. In fact, it's inverted in some parts of the system. But here's what the ratio doesn't tell you directly. It doesn't tell you where the scarcity is. It doesn't tell you whether it's above ground or below ground. It doesn't tell you whether it's in vaults or in transit. It doesn't tell you whether it's available for delivery or locked in industrial pipelines. The ratio is a surface signal. The delivery system is the reality underneath. And the delivery system is where this gets serious. Let me explain how the silver market is supposed to work. There are two markets for silver, the paper market and the physical market. The paper market is where futures trade. The physical market is where metal actually changes hands. In theory, these two markets are connected by a mechanism called delivery. If you hold a futures contract to expiration, you can demand physical metal. That's the linkage. That's what keeps paper prices anchored to physical reality. But here's the assumption everyone relies on. Most people don't take delivery. They roll their contracts, they cash settle, they close out before expiration. The system is designed around that assumption. The amount of metal in registered vaults, the metal actually available for delivery, is sized for a small percentage of open interest, not all of it. A fraction. This is where the math starts to matter. Let's say registered silver inventory sits at 120 million ounces. That sounds like a lot. But open interest in silver futures can exceed 800 million ounces notionally. That's a coverage ratio of roughly 15%, meaning if more than 15% of contract holders demand delivery at once, there isn't enough metal to go around. Now, in a normal market, that's fine, because most people don't want the metal. They want the exposure. They want the price movement. They roll, they hedge, they close. The delivery mechanism is a backstop, not a bottleneck. But what happens when physical demand shifts? What happens when industrial users, sovereign buyers, and ETF custodians all start pulling metal out of the system at the same time? What happens when the delivery mechanism stops being a backstop and starts being a constraint? That's when the ratio collapses. Because the paper market can print contracts all day, but the physical market can only deliver what exists. And when delivery stress rises, the market that clears faster, gold, becomes relatively less scarce. Silver becomes relatively more scarce. The ratio compresses. Fast. 60 days, 55 points. That's not sentiment. That's delivery stress showing up in the only metric that can't be manipulated, relative price. Here's the critical point. The official narrative you're going to hear, the one that's already circulating, is that silver simply outperformed because of speculative enthusiasm. Retail piled in. Momentum traders chased. The usual story. And that narrative will satisfy most people. It explains the price move. It doesn't explain the ratio move, because gold is also at all-time highs. Gold also has speculative interest. Gold also has momentum. If this were pure speculation, the ratio would stay flat. Both metals would rise together. The ratio compresses only when silver is being pulled harder than gold. And that kind of pull doesn't come from speculators. Speculators trade paper. They don't drain vaults. The pull comes from physical demand. And physical demand comes from three sources: industrial consumption, investment accumulation, and sovereign stockpiling. All three are accelerating. And none of them are showing up in the official inventory reports the way they should. This is where it gets uncomfortable. Let me walk you through a scenario. Not a prediction. A scenario. Assume registered inventory stays flat at 120 million ounces. Assume open interest stays elevated at 800 million ounces. Assume physical demand continues at the current pace. Let's call it a drawdown rate of 8 million ounces per month from the deliverable pool. At that rate, the coverage ratio drops from 15% to 12% in 90 days. It drops below 10% in 6 months. Below 10% is where the system starts to behave differently, because at that level, any spike in delivery demand, any single large standing for delivery event, can trigger a cascade. Here's how the cascade works. A large buyer stands for delivery. The exchange assigns delivery notices to short holders. Those shorts either deliver metal or buy it in the spot market to deliver. If the spot market is tight, and it is, the buying pressure pushes the spot price up. The rising spot price triggers more delivery demand from other longs who see the premium. More delivery demand means more buying pressure. More buying pressure means higher prices. Higher prices mean more delivery demand. The loop feeds itself. Now, normally the exchange can cool this by raising margins. Higher margins force leveraged longs to exit. They reduce open interest. They take pressure off the delivery system. That's the release valve. But here's the problem. Margins have already been raised multiple times, and the delivery pressure hasn't stopped. In fact, it's accelerated. That tells you something important. The longs standing for delivery aren't leveraged speculators. They're funded buyers. They can meet margin. They want the metal. When margin hikes don't reduce delivery demand, the exchange has only one option left: change the rules. Restrict delivery. Impose position limits. Declare force majeure. These are not hypotheticals. These are procedures. They exist in the rulebook. They've been used before. Stay with me. This is where the two realities split. In the paper market, the price of silver is whatever the last futures contract traded at. Let's say it's in the low 90s. That's the print. That's the number on the screen. That's what most people see. In the physical market, the price of silver is whatever a buyer has to pay to actually get metal in hand. And right now, that number is diverging. In some regions, physical silver is trading at double-digit premiums to the paper price. In others, it's simply unavailable at any price. Delivery times have stretched from days to weeks to months. Refiners are back-ordered. Mints are rationing. This divergence is not supposed to happen. The whole point of the futures market is to anchor physical prices. If the two markets diverge, the futures market loses its function. It becomes a fiction, a number on a screen that doesn't correspond to anything you can actually buy. And when that happens, trust breaks. Here's the sequence. First, premiums widen. Physical buyers pay more than paper price. This is already happening. Second, arbitrageurs step in. They buy futures, stand for delivery, and sell the physical at a premium. This should close the gap. But it only works if delivery actually happens. Third, delivery fails to keep pace. The arbitrage breaks down. The gap widens further. Paper and physical become two separate markets. Fourth, paper holders realize their contracts aren't backed by metal. They either exit or demand delivery. Either way, the system destabilizes. Fifth, the exchange intervenes. They change the rules. They restrict delivery. They force cash settlement. The paper price becomes meaningless. The physical price becomes the only price. This is not speculation. This is the documented sequence from every delivery crisis in commodity history. It's how the Hunt brothers' silver corner ended. It's how the nickel squeeze resolved. It's how every physical paper divergence eventually reconciles. The The only question is timing. Let me give you 3 scenarios. Scenario 1, demand cools. Industrial consumption slows. Investment interest fades. Sovereign buying pauses. The delivery system catches its breath. Inventory rebuilds. The ratio stabilizes. Premiums compress. This is the soft landing. Probability? Low. Because none of the demand drivers are cyclical. They're structural. Solar, EVs, grid storage, defense. These aren't going away. Scenario 2, the system breaks disorderly. A major delivery failure triggers a loss of confidence. Paper holders rush to exit or convert. The exchange suspends trading or forces cash settlement. Physical prices gap higher. The paper market becomes untethered. Lawsuits follow, regulatory inquiries follow. Trust in the exchange mechanism collapses. This is the hard landing. Probability, moderate. It's not the base case, but it's not a tail risk anymore either. Scenario 3, the system breaks orderly. The exchange sees the stress coming. They preemptively restrict delivery. They raise margins to punitive levels. They impose position limits. They manage the unwind in slow motion. Paper prices correct. Physical prices stay elevated. The divergence becomes permanent but controlled. This is the managed devaluation of the paper market. Probability, highest. Because this is what exchanges do. They protect the system, not the participants. Notice what all 3 scenarios have in common. In none of them does the paper price remain the true price. In all of them, physical silver becomes the reference. The only question is how chaotic the transition is. This is where it changes. If you're watching this and wondering what to look for, here are the signals. First, watch registered inventory. Not total inventory, registered. That's the metal actually available for delivery. If it drops below 100 million ounces, the math gets very tight. Second, watch delivery notices. These are published daily. If the number of contracts standing for delivery exceeds seasonal norms, stress is building. Third, watch premiums. Not just dealer premiums, wholesale premiums. What are refiners charging above spot? What are ETFs paying to source metal? If those numbers rise, the physical market is tightening. Fourth, watch the ratio. If it compresses further into the 40s, it's telling you that silver scarcity is accelerating relative to gold. That's a leading indicator. Fifth, watch exchange announcements, rule changes, margin hikes, position limit adjustments. These are tells. They signal that the exchange sees something the public doesn't. None of these are calls to action. They're observation points. They're the dials you monitor when the system is under stress. Let me zoom out. What's happening in silver is not isolated. It's part of a broader repricing of physical scarcity across commodity markets. For decades, the assumption was that paper markets could absorb demand, smooth volatility, and provide price discovery without ever facing delivery constraints. That assumption held because demand was fragmented and supply was abundant. That's no longer true. Demand has consolidated. Industrial buyers are competing with investment buyers. Investment buyers are competing with sovereign buyers. Everyone wants the same metal, and supply hasn't kept pace. Mine output has plateaued. Refining capacity is constrained. Inventory buffers have been drawn down. The result is a system that looks stable in price but is increasingly unstable in structure. The price can print whatever it wants, but the metal either delivers or it doesn't. And increasingly, it doesn't. Silver is the canary. It's the smallest of the major metals markets. It has the thinnest inventory buffer. It has the highest industrial demand growth. It's the first place delivery stress shows up, but it won't be the last. What you're watching is the beginning of a repricing of physical scarcity. Not in theory, in practice, in delivery times, in premiums, in ratios, in the gap between what the screen says and what you can actually buy. The gold-silver ratio didn't collapse because traders got excited. It collapsed because the physical market is screaming what the paper market can't say. There isn't enough. The question is not whether this resolves. It will. It always does. The question is how, and how long the system can hold the current fiction before the math forces a reconciliation. 60 days, 55 points. That's not a trade. That's a signal. Watch delivery.